Hey everyone, welcome back to Corporate Decoder, the place where we try to unravel the secrets hidden within stacks of corporate paperwork. And today we're diving deep into some semi-annual shareholder reports that reveal a lot about where the money is flowing in the world of variable insurance portfolios. And boy, do we have a story for you today about some serious investment moves. We are looking at the Ivy variable insurance portfolios for the period ending June 30, 2025, and this isn't just a dry financial report, it's a snapshot of financial maneuvering, a tale of strategic investments, and a look into the inner workings of these complex financial vehicles. So before we get lost in the numbers, make sure you're subscribed for more deep dives like this and join our Discord community linked in the description to continue the conversation. This filing is essentially a report card for the Ivy variable insurance portfolios. It tells us how various series within this portfolio have been performing, what they are invested in, and what their financial health looks like. Think of it as the company's diary for the last 6 months, showing their triumphs and their challenges. So what's the headline here? Looking at these reports, we see a consistent theme across many of these series, like the Macquarie VIP Asset Strategy series and the Macquarie VIP Balance series. They are holding massive amounts of common stocks with percentages like 58.70% and 59.37% respectively. This tells us they are betting big on the stock market, hoping for growth. And when we look at their top picks, it's the usual suspects, the tech giants we all know, Microsoft, Nvidia, Amazon, Apple. These aren't just random choices, these are companies that have shown incredible growth and resilience, and these portfolios are heavily invested in them. For instance, Macquarie VIP Asset Strategy series has 3.52% in Microsoft and 2.67% in Nvidia. These aren't small stakes, and it signals a strong belief in the continued dominance of these tech titans. The Macquarie VIP Asset Strategy series alone manages a staggering $579 million. That's a huge amount of money and a huge responsibility to its investors. Every decision made here has significant weight. But it's not all stocks. We see substantial holdings in agency mortgage-backed securities, a whopping 8.97% in the Asset Strategy series. This is a bit more traditional finance, a sector that has been a bedrock for these types of portfolios, providing steady income and a level of stability away from the wild swings of the stock market. Now let's talk money where it really counts the cost. For a hypothetical $10,000 investment in the Macquarie VIP Asset Strategy Series Standard Class, the cost for the last 6 months was just 31 at 44, representing 0.60% of the investment. That's pretty lean, showing a focus on keeping fees down, an important detail for any investor. However, the service class of the same series costs a bit more at 44 or 0.85%. This just goes to show how important share class can be. The portfolio turnover rate for the Asset Strategy series is 38%. This means they are buying and selling about a third of their holdings each year. It's not an extremely high turnover, which suggests a strategy that's more about long-term holding rather than rapid trading, a good sign for stability. Let's look at another series, the Macquarie VIP Growth series, in its service class. A $10,000 investment would have cost you $51, which is 1.01%. It's worth noting that this is annualized, meaning over a full year this might be higher. These costs are crucial because they eat into your returns, and seeing them at around 1% or less, as we saw in the Asset Strategy series, is commendable. The Macquarie VIP Growth series is also a behemoth, managing over $607 million. This growth focus in its name is reflected in its sector allocation, heavy on information technology and financials. The Core Equity series shows a strong lean towards information technology at 30% and financials at 41%. This is a clear strategy betting on knowledge-based economies and financial infrastructure growth companies that drive innovation and manage capital. And who are they backing? Microsoft at 7.28% and Nvidia at 5.54% are their top holdings. This isn't surprising given the tech boom, but it also signals a potential concentration risk. If these tech stocks take a hit, the entire series could feel the impact. Now let's talk risks. It's not all smooth sailing. The report explicitly mentions credit risk, interest rate, risk, prepayment risk, and extension risk for their fixed income holdings. For mortgage-backed securities, they highlight sensitivity to interest rate changes and the impact of borrowers refinancing loans. This means their value can swing quite a bit with market interest rate changes and the impact of borrowers refinancing loans. This means their value can swing quite a bit with market interest rate changes and the risk that borrowers might pay back loans faster faster or slower than expected. The story within these filings is one of strategic positioning and calculated bets. The Ivy Variable Insurance portfolios, through their various Macquarie VIP series, are heavily invested in growth sectors, particularly technology and financial services. They are also playing it safe with significant holdings in mortgage-backed securities and US Treasury obligations, a classic move. To balance risk and reward. Then there's the Pathfinder series. They are like ultra-diversified funds investing in other funds. This is a smart strategy to get broad market exposure without picking every single stock themselves. Looking at the overall direction, strengths are clear. They are heavily invested in growth areas like tech and financials, showing confidence in these sectors. Their focus on low costs for standard share classes is another strength. Weaknesses arguably come from the concentration in a few large tech stocks. While these companies are strong, their continued outperformance is not guaranteed. For the Pathfinder series, their strength is diversification. Their weakness is that they are paying fees for underlying funds which still have their own costs. A notable risk is market volatility, especially in the tech sector. An economic downturn could hit these tech-heavy portfolios hard. On the flip side, there's the opportunity for continued growth in these sectors and the potential for the underlying funds in the Pathfinder series to outperform their individual fees. Scroll conclusion, these reports paint a picture of a well-managed, diverse set of investment portfolios. They are strategically placed for growth through tech and financial investments while maintaining a degree of stability with fixed income and mortgage-backed securities. The Pathfinder series offers a simplified, diversified approach. However, like all investments, there are risks associated with market fluctuations and the concentrations in specific sectors. Investors should always do their own research and understand these risks before committing their capital. Alright, that's our deep dive for today. What are your thoughts on these investment strategies and their potential impact? Let us know in the comments below if you found this breakdown helpful. Give it a thumbs up and subscribe for more corporate secrets revealed. And don't forget to join our Discord community linked in the description to keep the conversation going. Thanks for watching, and we'll see you in the next episode of Corporate Decoder.